Good afternoon, everybody, or good morning, depending on where you are in the world. Thank you very much for joining us today. This is Ian from SOFTRAX, and we're very excited to be joined by our partners at CFGI today to produce this webinar for you, Operation Contract Modifications under ASC 606. So I'll just say a few words about a few housekeeping things while we're still waiting for some attendees to trickle in. This will be a CPE eligible webinar, eligible for 1 CPE credit in accounting with your full participation. So as long as you stay online for the entirety of the webinar, at least 50 minutes out of the 60-minute hour, and you participate in all 4 polling questions, which will be interspersed throughout the presentation, then we will be able to provide you 1 CPE credit. For the polling questions, you'll be able to answer the polls just using the GoToWebinar console on the right side of your screen. Please feel free to submit a question or submit a chat if you have any technical difficulties. If at any point you do have any questions during the presentation, please feel free to submit a question in the box to your right. We may or may not have time to answer questions at the end, depending on the presentation's timing, but we'll make sure to reach out after the fact and make sure that all questions are answered. So with that, I think I will go ahead and I'll introduce our speakers for today. As I mentioned, we're excited to be joined by Kyle Britto at CFGI, a senior manager at CFGI, and also Tom Zauli on the SOFTRAX side, our SVP and general manager. So I'll let them introduce themselves. Kyle, if you'd like to say a couple of words about your experience.
Awesome. Thank you, Ian. So my name is Kyle Britto, senior manager here at CFGI. I have over 10 years of experience across a different number of technical accounting areas. And the last 6 years have been in revenue.
Yep, and I'm Tom Zauli, so Senior Vice President and General Manager of SOFTRAX as a division of AFS Technologies. We've been focused, heads down in complex revenue management, which includes complex billing and revenue recognition solutions designed to plug into existing ERP to fill a gap. And my background goes back to early days as an electrical engineer at GE Aerospace. And happy to be here and happy to be presenting with Kyle today.
Excellent, thank you both. So I'll run through the agenda briefly. We want to hit a couple of key points, namely background on the ASC 606 contract modification guidance for anyone who may be less familiar. And then we'll get into the challenges. The common challenge is scalability. We'll get into some real world examples and some applications of this guidance in practice. And finally, we'll get into how these challenges are overcome. Tom and Kyle, anything to add before we jump into the first polling question?
Nothing on my end.
Nope, I don't think so.
Excellent. So I'll go ahead then, and I will fire up the first poll. Quite simply, where do you stand in terms of ASC 606 or IFRS 15 adoption? You haven't adopted the standards. Have you adopted portions of the guidance and processing manually? Are you processing portions fully automatically? Or are you totally automated at this point? So I'll go ahead and launch the poll. All right, we see about 90% of people have voted. So if you're still thinking, go ahead and submit your polls, submit your responses, and I'll close this one up and we can get into the presentation. All right, and I will go ahead and close the poll. So Tom and Kyle, I'm not sure if you can see the results, but it looks like a whopping 51% of people answered that they've adopted the full guidance and they're currently processing manually. And another 31 people have adopted the full guidance and they're processing automatically.
It's interesting. I think that's an increase actually in terms of level of automation. So that's good to see. I think early on it was sort of heavily manual, but it sounds like things are trending more toward automation, which is good. I don't know, Kyle, if you have any other comment on that.
No, that's actually great to see that a lot of people have adopted the guidance and just interesting to see how they're processing it.
Excellent. And speaking of the guidance, we can go ahead and move into navigating the ASC 606 contract modification guidance. So Kyle, I believe I'll turn it over to you here.
Perfect. Thank you, Ian. And thank you to everybody on the webinar for joining us and coming to talk about ASC 606 contract modifications, a topic I find interesting and near and dear to my heart, but I understand if you guys don't. So as we get started, let's just set the stage on what modifications are so that everyone has a base level of understanding before we discuss some of the complexities in practice, some of the things you guys are probably already seeing at this point. So what is a contract modification? A modification is when a customer changes the rights and obligations to a contract subsequent to its origination. Commonly, this is usually through an addition or removal of goods and services from the original contract. Let's say, for example, you enter into a contract with a customer to provide services and the customer adds a new but related product subsequently. Think about a new license or a new module to an existing product. When we adopted ASC 606, we had the use of several expedients to aid in the use of adoption. However, now that most of us have adopted, according to the polling as well, we need to account for these modifications as they occur within the normal business cycle, without the benefit of the experience and hindsight. And this is the problem, we don't know when the mods will happen. So this slide here is our, this is our 606 decision tree. We're not gonna go through all the buckets that are on here. We'll kind of go through them through future slides, but just a few things I want you guys to pull out from here. One, under ASC 606, we now have more of a decision tree practice, whereas under 605, it was more principle-based. The other thing is each contract that we enter into or gets modified has to go through these different questions in order to account for it appropriately. This is our first step in our journey, just to get a baseline of where we're going. And like I said, we'll see the boxes kind of shake out on the next slides. So if we go to the next slide, the decision tree we just had can be broken down into two kind of core considerations that we have to address for every modification. The first one is, are you adding a distinct good or service to the contract that's different from the original? And then two, are those goods or services being sold at their standalone selling price? So what does it all mean? Well, let's boil down these two pieces here. So the first one, is it distinct? This one should be a little bit easier to follow. When you adopted ASC 606, you would have gone through and identified your distinct performance obligations. And as long as what you're selling lines up to that, this should be an easy confirmation exercise. The next part is the good or service being sold at relative standalone selling price? This one's a little bit trickier, but in essence, what you're trying to understand is what I'm selling in the modification priced at what the customer's normal price list is or price range. What we're trying to get here is we want to make sure we don't have any excessive discounts on the new product that may impact what the original contract was. Think of here as like add-on products, any modules or upgrades. And with that, we'll turn to our next slide. So now we've been able to go from the decision tree, we simplified it to kind of two questions. We're going to look at what's the impact if either both, one, or none of the criteria are met. And that's what this slide is showing us here. So our first column to the left is what happens if we meet both criteria. So that the goods are distinct from the original contract and that the goods are sold at their relative standalone selling price. If we do that, ASC 606 states that we treat that as a new contract. And we just treat that as its own contract, recognize the revenue as we transfer obligations. The middle section here is what happens if we only meet one of the two criteria. And whether it's the product is distinct, but it's not sold at a selling price, which is what we typically see, or it's not distinct and it is sold at its selling price. And what the guidance says to here is we treat this as a prospective contract. And in essence, we would terminate the existing contract at the date of modification and create a new one that would run out as the objectives are transferred. And our final bucket here on the far right is something that we don't see that often, but it does happen out in the real world. And it's what happens when we don't meet either one of the criteria. So the service the customer already has, so therefore it's not distinct. And then we tend to give the pricing is a little bit lower than what we've had in the past. The best example I can give here is a customer retention discount. So let's say the customer is unhappy and they're thinking about going elsewhere. So we tend to give, let's say, a 20% discount here. If we don't meet any of the criteria, we have to treat this as a cumulative catch-up and bring whatever the modification is back to the contract inception. And then we would have to recalculate our revenue based upon contract inception to the date of modification, as if the modification was part of the original deal. And then again, the revenue would spread as the remaining obligations are transferred. And with that, we'll go to our next slide, which is our polling question.
And it looks like our next slide is a polling question. Simply, what is your status regarding contract modifications and combinations? Is it new to you? Are you aware of the guidance but currently don't have a requirement to process? Are you currently manually processing the guidance, or are you currently automatically processing the guidance? So I'll go ahead and launch the second question. And if you can please all go ahead and submit your responses in the GoToWebinar console. All right, and it looks like just about everybody has voted. So if you're still thinking, then please go ahead and submit, and I'll close the poll. And this response is a little bit more evenly distributed. Tom and Kyle, it looks like 30% of the attendees answered that this is new to them. They're hoping to learn more about it. 5% said they're familiar, but they don't have the current requirement to process modifications or combinations. 51% said they're familiar and they're currently processing the guidance manually, and 14 answered that they're familiar and currently processing automatically.
It matches my expectation. Yeah, yeah. Well, I think there you go. Yeah, I think.
How's that?
There we go.
Yeah.
The last surveys we've done, there's been very few people processing automatically. So that part makes sense. The number that are currently processing manually has shot up, though. That 51% in prior surveys was on the order of 20 to 30%. And then the other two, historically speaking, I think the 30% being new is probably in line. So yeah, I mean, so it's the big change is the third one, currently processing manually. I don't know, Kyle, if you have that same view.
Yeah, no, that makes sense. And if I can just quickly touch upon contract combinations really quickly, I think this is a perfect spot for it here, given everybody's responses here. So I just want to touch on the difference between a contract modification and a contract combination, right? So a contract combination is when an entity kind of enters into two contracts at or near the same time with the same customer or related party, right? And the rules here say that if the contracts are negotiated with a single commercial objective, and the consideration in one contract affects the other, and then the goods and services are promised to perform one performance obligation, you want to kind of combine the two contracts, right? Because you want to make sure that you're not negotiating two contracts and you're breaking it out just for ease sake, and you're actually thinking about combining it. I know in practice there's a 90-day policy where a lot of my clients will look back 90 days to see if they entered into two contracts with the same customer, and they'll determine if they have to combine them or not. But that's just their practice. It's not really guidance, but I do know a lot of people do that.
Thank you very much, Kyle. And as we move on to the common challenge, scalability.
Yeah, so now that we have an understanding of the guidance at a high level, right? We're going to look to understand how the guidance interacts with challenges in operationalizing. So although contract mods are not new under 606, in certain industries like SaaS, customers often have more control over their subscriptions and how often they change them. They can add more licenses, add new modules, etc. And therein lies the challenge. How do we account for the sheer volume of these modifications and recognize revenue appropriately if modifying transactions is a normal part of your recurring business? And based on the polling question, it sounds like a lot of you guys are doing this, albeit manually. So what does it all boil down to? If you have a simple contract with a simple customer, this process can be done manually with ease, as some of you guys are doing, because all you're going to do is you're going to apply the new 606 judgments on an individual basis, which is not that complex based upon the decision tree we just had. However, if you're going through an acquisition, you're expanding your offerings, you're expanding in different markets, you're adding on new products, adding on new customers, anything essentially adding new types of transactions to your business that weren't there before, this can become more challenging all of a sudden. Further, as mentioned previously, contract modifications in certain industries are becoming much more common, especially in software, where the customer has their own control over their experience, their product tier, and related pricing, and those can change frequently. All of this as a volume component when applying judgment across many contracts. And this opens the door for many new challenges that could have a direct impact on the financials. Things like a longer close cycle, risk of human error, any audit issues, just to name a few. And finally, this all is further impacted by what we call these indicators for degrees of difficulty. Some of them being contract duration. So if you have a short-term contract versus a long-term contract, it's easier to modify a short-term contract, especially if you have to go back to contract inception. It's easier to kind of see the pieces. If it's a long-term contract, it's going to be a little bit harder. So I know some of my clients typically have a 6-year contract life, and they typically see modifications in year 3, 4, 5. And just being in those outer years tend to add more complexity. And it's harder to get back, especially if you have to do a retrospective approach and bring it back to the original contract term. Another piece is your pricing model. And this is more around variability of discounts. We want to make sure we're not giving heavy discounts to customers to entice them to use the product. And we want to make sure that discounts are consistent across the board. And then the last part on this slide is the performance obligations. And this is more so within the same deal, not necessarily having different products, right? It's when you add like software with maintenance, with support and training, when you tend to add more performance obligations in one contract, you get into these multi-element arrangements, and sometimes they don't have coterminous dates. So if you modify one of those 4, you're going to have to identify the impact on all the other performance obligations you have in the contract. And this is all to say that this adds in complexity to contract mods, especially again, like I said, that you have to go back to like the first date of the contract. So if we go to the next slide, it's going to be time for the real world cases, which is the fun part here. These are the parts that I like. These are clients that I've been on in their different scenarios. And the next 4 slides will demonstrate how even the slightest changes can affect the accounting treatment. So our first slide here is just our fact pattern, just to level set. This is our original contract and what we'll be building off of, right? So company ABC enters into a contract with customer 123 for 3 SaaS subscriptions for a 3-year term. In this agreement, we also have subscription revenue and maintenance. In addition, the customer is going to buy some professional service to help with the implementation. One thing to note that's going to come up later is that this batch of professional services was completed on February 15th. So if we look to the right and we just pull out kind of the key pieces here, we have 3 POVs, our subscription, our support, and our services. Our contract is going to last about 3 years. And then as you can see, these our accounting considerations are our two key considerations here, and we're gonna see these on all the slides and how answering these different changes our accounting. So the first one is, are the goods distinct? Well, this one's easy. Yes, they are, right? We have our subscription, we have our support, we have our professional services. The next question is, are they sold at SSP? And again, yes, we don't mention any discounts in the fact pattern. So the 606 revenue conclusion would be to recognize the revenue over 36 months, and then the professional services as they're transferred, in this case in February. So we'll move on to our next one here. So let's say customer is going along, the implementation went well, we're moving on, customer decides to hire some new employees, and they would like to train the employees. So in July, they purchased some training. So we look at this modification, and we see that it's just a purchase of training. After the modification, we look at what are the POBs, and they are subscription, support, professional services, and training. So again, we're going to go through our two accounting considerations. One, is the training distinct? And yes, as we can see from above, we started with 3 performance obligations. We're now at 4, and training itself is just unique. Second, is the training sold at SSP? And again, yes, we don't mention any discounts, so we're going to assume that it's at general selling price. So under 606, we would get to the point where the training is treated as a separate contract, and we would recognize the revenue for that as the training takes place. So that's the easier one of the two. The next one here is when we start to get into a little bit of complexities here. So let's say we've done the implementation, customers up and running, and then they decide to come back and buy more professional services. Maybe there's something they forgot to add on. So the modification on the right is now this purchase of additional services. And now our POB, our performance obligations after the modification, are subscription, support, and services. And those 3 match exactly what was in our fact pattern to begin with. So if we're looking at our accounting considerations, are the goods distinct? No, because again, those 3 are the same 3 we've had in the first fact pattern. So the second question is, are they sold at SSP? And we can say yes. Again, we're not mentioning any discounts, so we'll keep that there. So what shakes out for 606 is that we would treat the new professional service modification as a change of the original contract, and we would take the remaining revenue on the old contract and bring it into this new contract, and then we would recognize it over time as the obligations are transferred. So since this one is a little bit complicated, just to recap, after the original PS was implemented, the customer bought more professional service. The performance obligations are exactly the same to the original fact pattern. So this would result in the termination of the existing contract on the date of modification and the creation of a new one, and recognize the revenue as the obligations are transferred. So in essence, one contract becomes 2. And this is an example of a prospective modification. So then we'll go to our last one here, which is the more complex of the 3. As we mentioned, don't typically see this too much, but it does happen out there. I'm pretty sure some of you guys may have seen this, especially if you're doing this manually. So let's say, again, back to our fact pattern, the customer is going along, but something hits a snag. So they need to add more professional service. So let's say in January, before the February completion date, they go on and add more professional service. But additionally, we want to make sure that they're happy, so we offer them a 20% discount on these services. So the old services have not been completed yet, and in addition, we give them a discount on it. So we look at the fact pattern on the right. This is another modification, just adding more professional services. Our 3 performance obligations are still the same as they were before: subscription, support, and services. But now our 2 accounting considerations change, right? Are the goods distinct? Well, no, because again, it's the same as the ones we had in the fact pattern. And then are they sold as SSP? And the answer again is now no, because we do have a 20% discount. So what we would need to do is we would need to, under 606, treat the new professional services as a modification of the original contract by recognizing a cumulative catch-up at the time of modification, which would be the value of the professional services if they were included in the original contract. And this one is a little bit more tricky. So just to kind of bring it all together, so we never deliver the first batch, fully deliver the first batch of professional services before the customer buys more. And therefore, it's not distinct, and we give a discount. So as we don't meet either of the criteria, we will have to determine the cumulative catch-up to recognize the PS revenue as if it was part of the contract from day one. And that's where it gets a little tricky. It's going back to day one, especially if you're not sure if it's like a longer duration contract. And with that, we'll go to the next polling question.
Kyle, can I just interject first? We actually just got a question submitted. Could you clarify a little bit more about the catch-up that you mentioned? We had a question asking for a little bit more clarification on, the effectiveness of catch-up.
Yeah, so the catch-up becomes a little tricky to calculate. So in our example, let's use our example. We might have a little more time here, but in essence, what you would do is you would say, I had this contract, and I've been recording revenue all along, let's say 3 months in this case, right? And then on month 4, I have this modification come in. Well, because I'm not providing anything distinct, and it is at a discount, I would need to, in essence, go back to month 1, bring back the professional service and the discount and the transaction price, reallocate it between now my 3 performance obligations, and then I would figure out what's my revenue pattern at day 1 with new professional service. And then I would have to compare that to what I've already recognized. And the difference between the two is going to be your cumulative catch-up. So if you were recording $100 a month for the last 4 months, but you should have been recording, let's say $50 a month. So by the time you get to month 3, you have $300 in revenue versus $150. Your cumulative catch-up would be a negative $150. I hope that answered the question.
Thank you for that, Kyle. I appreciate it.
No
so
problem.
we can go ahead and we can move into the third polling question. And if there are any other questions, feel free to submit them through that questions panel. We'll be happy to elaborate on whatever is needed. So I'll launch question number 3. At what level are you currently processing contract combinations and/or modifications? We'll go ahead and we'll speak a little more in depth about sort of each of these levels, but knowledgeable people in finance reviewing each order and manually setting them up for recognition, manual review of each order, and configuring technology tools to instruct the proper recognition, or a policy for revenue recognition in technology done once and automated work of that policy. And as I mentioned, these 3 levels will be sort of the centerpiece of the 4th quarter of our presentation, a little more in depth about each of them. So it looks like just about everybody has voted. So if you're still thinking, please go ahead and submit that answer. And I'll close the poll and I'll pull up the results. So Tom and Kyle, this question is a little bit more evenly distributed than what we've seen before. I don't know if you have any thoughts, either of you.
It looks.
I think it's interesting.
Yeah, I would say it definitely interesting. Probably a result of the higher percentage of people that are actually having to deal with these now. Because I see more on the half manual, half with technology bucket, past surveys, the there was, on the order of 10% that was fully automated, but I think it was probably more weighted toward manual versus half manual, half with technology. But I think as more companies have to do this, you're seeing more high volume cases, and they have, they can't do it all manually. So it sort of it's going to drive this number up. I think that will continue.
Great. Thank you both. Thank you everybody for answering. So we can go ahead and move forward here, and we get into solving the challenge, solutions for operationalizing 606 modification and combination guidance. So I believe I'll turn it over to Tom at this point.
Yeah, thank you. Yeah, so we talked briefly about 3 levels, and so to give also some historic perspective, I mean, the level 1, this form of processing, I think predates even 606. So it's been around for a while, and what we define as level 1 is as we discussed in the polling question, it's really where not only, if you break it down, you can think about the decision process in terms of what to do, and then the act of doing whatever you decide to do. So at level 1, it's considering that both of those halves are manual. So somebody's coming in, and with the 606 guidance, I would say, it has to be somebody, pretty darn knowledgeable on the guidance, coming in to look at incoming transactions and understand if they are candidates to trigger either a combination or a modification. If they are, then, either that same person or someone else is then, effectively manually setting up the treatment. And it's either, usually done in Excel or whatever. Level 2, which is where I think, even the most advanced solutions have been for quite some time, suggests that still, and, primarily due to this, some of the subjective nature of the guidance, that still you have that decision process still requires the application of human intelligence on a sort of a transaction by transaction basis. And then once they understand and make the decisions on what to do, then, they're able to effectively set it up, if you will, in a technology, and have it process. And even there, I mean, if done right, Excel can be a somewhat automated tool. So when somebody selects the appropriate treatment, they could potentially have it calculated through Excel. To give perspective on where we are at, going back to 2016, we effectively exposed APIs that would handle each type of action to be taken in combinations and modifications. So whether it was a retrospective allocation, a prospective allocation, a cumulative catch-up. So all early adopters, at least that were working through our solution, would have to either manually select those as type of a level 2 situation after making the decision themselves, or they would build, as was frequently the case, they would build into the integration layer decision making, and therefore do it as policy. And that's a good segue into level 3. So level 3, it assumes both are automated, and not an easy problem to solve from an operational perspective, but I do think solvable. And so here, you're establishing a policy one time, and potentially with modification over time as you do M&A activity and sell new things and etc. But you're effectively training the technology on how it itself can make the decisions and carry out the treatments resulting from those decisions. We started working on this in about 2018. I'll explain a little bit more about where we're at in our roadmap. We're about 75% of the way through it. And so one thing I would say, I mean, a lot of people we talk to are like, especially low volume companies, are saying, well, it just doesn't seem possible to fully automate this in the context of the types of either combinations or modifications I have. But, we have a fairly broad perspective. So, we do hear that, and we understand the questions, et cetera, but you have to understand that at the high end of the scale, I mean, we have clients that, they're processing like hundreds of thousands of transactions a day. And so even though the percentage, on a percentage basis, the number of combinations or modifications they have to deal with is low, I mean, it might be on the order of 5%, 10%, even 3%. still against that volume, it translates into either thousands or tens of thousands of these potential modifications and combinations. And so they really have no choice. I mean, it would be extremely expensive for them to even operate at level 2. And so that is what originally spurned heavy effort on our part to get this operationalized. And if you go to the next slide, we can talk a little bit about some of the reasons for doing it. And so why go this way? I mean, the big one, it really was driven by these higher volume clients. It's not efficient to have human resources. You'd be talking 20, 30, 40 people doing this to keep up with the load. The second one I personally think is equally important, and that's around risk. So the benefit of a policy, if well done, is that once you've set it up and let's say the machine is working properly and it's tested, whether it's doing 1 or 100,000 or 1,000,000 of these things, it should not make a mistake. The trick is the policy correct? Second, third, on a compliance level, the idea is when you're dealing with your auditors is like, I now know exactly what my policy is. It's actually documented in the configurations of the technology. And I know that it's being followed on every transaction because it's enforced by technology. That is a huge leg up, in my opinion. And there are, of course, audit reports in our technology and others. I mean, where it will tell you if the policy has changed over the last 3 months. It will tell you if somebody has done something outside of the policy. So the controls really get amped up. And then, just speed. I mean, just having the stuff, not only just automatically processed, but having the results in a systematized database, you can see a major step up in terms of the speed to close. And it is a good approach, even outside of modifications and combinations, just in your revenue recognition processing and other parts of the back office to get to level 3, because it's an enabler for continuous accounting. So it's an enabler for sort of straight through processing and getting down to a 2-day or lower close period. And so, okay, you can go to the next one, Ian. So just a little bit, I just wanted to set some context as we talk about sort of the internals of the operationalization. So for people that aren't aware, we have a product called SOFTRAX Revenue Manager. It is effectively a plugin to whatever existing ERP exists out there, and it is a revenue subledger, a revenue recognition subledger. So it takes feeds from upstream systems, and it's fully compliant with 606. So it takes the sales order data, total contract value. It takes any fulfillment data. So if there's contingent revenue, things are on hold pending delivery, things like that. It takes that data in. And it takes in bill data in order to perform contract asset liability management and spits out summary journal entries. So that's sort of the context. And again, it can plug into a large ecosystem of systems. If you go to the next slide, Ian. So, drilling into how this gets operationalized, and this is, I'm speaking specific to our technology because that's what I know, but the pattern, if you will, I think is broadly applicable. So, in our approach, we've done 2 things. I mean, we've built APIs that are highly intelligent APIs, and what I mean by that is when a new order is available, an API can be called with that order data, and it will examine the previous history of that customer or related entity to understand what has been done, and it will return data related to that. It then leverages off of a set of configurations. So, for example, the time between orders is, as Kyle was mentioning, it's an important trigger, particularly for making decisions about whether combinations are appropriate. And so, as Kyle, I think, correctly articulated, the guidance says at or near the same time. So, for most of our clients, it may not always be the exact same time frame that they're checking, but they can establish a time frame. Maybe it's like Kyle said, 90 days. Maybe if you have very short contracts, it might be 30 days. But that can be established. So the system, armed with the API, armed with these configuration switches, basically receives orders, the API calls occur, it returns whether or not a combination or a modification is appropriate, and then calls other APIs to actually accomplish the work. Now, this same pattern exists in both cases, but from a technology perspective, just so you're aware, there are two technical implementations of this. One, for extremely high volume cases, is direct leveraging of these APIs from the integration layer. And like I say, in the 2016, 2017 sort of early adopter era, multi-billion-dollar companies, they had no choice. They were doing this via APIs, and in some cases, they would have had to anyway because their volumes were just so massively high. We have since then basically productized the decision part of it in the pattern that you see here at the top, which is basically a workflow engine. So in this case, implementation integration goes very quickly because basically it's been productized. So when transactions arrive, the processing that occurs is effectively this workflow engine. It makes API calls based on pre-existing configurations. It actually makes the decisions based on the returns from the APIs. So those API calls, you can think of it like transaction arrives, it reaches into the revenue manager database, it understands the past history for the client, examines the orders, examines the configurations like the timeframes. It goes through a decision tree that actually looks very similar to what you would see in the guidance or something you would see in like a Big Four opinion or something, and makes the decision on how it should be processed and whether it should be treated like a separate contract according to the guidelines that Kyle discussed. It should be treated like a combination and therefore would kick off a retrospective reallocation. Could be a prospective allocation because in fact, maybe it wasn't at SSP, it's all distinct, so it's really requiring a prospective allocation, and makes the calls not only to store the order but to do the appropriate processing, basically. Now it's soup to nuts supported out of the box, but I will talk in the next slide a little bit about the sets of use cases for which this applies today and where we are taking it tomorrow. So, next slide. So, when you're looking at this problem, and I think this will be helpful as you're examining, sort of what you're doing today, and is this possible in your current world? Because, we are the first to admit, particularly in the case of combinations, I think even more so than modifications, there are some subjective questions that need to be answered. So, the set of people that can apply level 3 guidance out of the box to our solution, it effectively is a growing set. As of today, we support full automation for both combinations and modifications, but there are caveats. In the case of contract combinations, if you are comfortable that if the time frame policy is met, meaning that if the contract came within 90 days, then you can safely assume that they were negotiated as a package with a single commercial objective, or the amount of consideration paid in one depends on the performance of the other, or C, this is all taken straight out of the combination guidance. The services promised in the contracts represent a single performance obligation. Then if you're comfortable with that, then it will just process automatically. In the future, we're going to enable data elements on the incoming orders. So for example, was it negotiated with a single commercial objective? We will enable that to come in. Now, there is an accountability argument that is occurring out there in the sense of, if that is going to be specified at order entry, it normally was in the province of the revenue recognition accountants themselves. And this would push it upstream. Enabling that field would say, okay, whoever's doing order entry, or perhaps you have these accountants involved in order entry, but they would have to set those flags. And what it will do, we will provide the technical capability. It will potentially move the accountability upstream a bit, but it will enable a far more, I'd say, a broader set of applicability of level 3 automation in the space. And that's what we're pushing toward. On the modification side, interestingly, in our opinion anyway, modifications, while they're more complicated, there's probably 4x the words written in the guidance regarding modifications. We use the word deterministic. So they are, from a machine perspective, from an operational perspective, we feel they are quite deterministic and they can be automated. We have a very solid plan. So right now, as you can see here, we deal with only distinct, only handling distinct. If we, in the November release, we will be able to bookkeep at a SKU level or at an override level, whether you can effectively tag the line items as distinct or not distinct. So in the SKU case, it's just stored as master data. So you have X number of SKUs and you just tag them one time, or whether they're distinct or not distinct. And we would just look it up. When the thing comes in, we would look it up and say, oh, there are non-distincts here. We do believe there will be cases where, due to the nature of the contract, a SKU could be distinct in one case and non-distinct in another. And that's the reason why we're adding this ability to add an override value. So effectively, think of it like the SKU is normally distinct and it's therefore stored in master data in the product catalog, if you will, with a tag of distinct. On this particular contract, it's known to be not distinct, and it would be passed in. We would see it. We check the override first. If not, we default to the master data. And in the next release, not that we're kicking the can down the road, but we will detect these different things and we will say, look, we have this thing, we've received it, we believe it is a candidate for modification, but we don't have enough information to handle it, and it will go up to a manual queue. And we always reserve the ability to handle these things manually within the context of the product, if you wish. And it is controlled by security, so somebody has to have the authority to do kind of a manual modification. If they do it, it's tracked and auditable and all of that. So that's how we view the operationalization. It's really the major milestone was a bit of time ago when we had the initial level 3 automation for both. Everything from there going forward, you can see releases coming up in November 2020, January 21, March 21. It's all about broadening the case of applicability. And right now, one of two things happen basically. Either the processing out of the box meets the need based on the client policy, or they have an imminent need prior to these release dates, and we work with them one-on-one to either support it out of the box in product or handle it via work in the integration layer, very similar to what we did in 2016, 2017 for the early adopters of the guidance. So hopefully that's clear in terms of how we're looking at this. But the final statement I will make on it is, if you're thinking, if for example, if you're at level 1 or you're at level 2 and you're thinking about level 3 and you think that it seems like it can't be done, we should talk, because I think in most of the cases that we've seen so far, not everyone, but most of them, it can be done. It's just a question of sort of how you look at what you're doing against sort of the policies that you're following, etc. And with that, Ian, you want to go to the next one? I think it might be a polling question.
Yep, looks like we have another polling question. What types of contract modifications and combinations are you currently working through? Neither. Do you have contract modifications with only distinct performance obligations, contract modifications that only include non-distinct performance obligations, or do you have both? So I'll go ahead and launch this one. So it looks like we'll have a little bit of time for Q&A. We have a couple of questions in, so if anyone has any others, feel free. Now is probably the time to submit those after you get your answers in here for this poll. Sort of another housekeeping thing, after the webinar, we'll distribute the CPE certificates via email, so no further action required on your part. And it looks like just about everybody voted. So I'll go ahead and close the poll in a couple of seconds. If anyone's still on the fence, please go ahead and submit that response now. All right, and I'll go ahead and put these results up. This one looks a little more one-sided, and looks like there was one answer that got 0%.
This one is a bit surprising to me. The fourth bullet is the shocker a little bit. The past surveys, the number of clients processing non-distinct performance obligations has been pretty low, on the order of, I don't know, maybe 10, 20%. So it looks like there's been a big jump up here, which is interesting to see. Kyle, I don't know if you have a comment on that.
Yeah, no, I agree with you. I think to your point, most of my clients have been more non-distinct, so I'm shocked to see that it's actually at 0.
Well, I think if I read this correctly, it's saying that there was very few that had only non-distincts, but there were 60% that had both distinct and non-distinct in the same order. That was the thing that sort of caught my eye.
Yeah,
is interesting. Yeah. So yeah, good. That's interesting to understand. There's a pretty good example in the. I found it hard in that fourth bullet. I found it hard, in the Big Four RevRec guides to find good examples that include both distinct and non-distinct. I do know, and I think it's page, not that I have the page memorized, but I think it's page 811 of the KPMG, the 2019 version of the guide, does include an example of both distinct and non-distinct being in a single order. They make recommendations on how to treat it. It's effectively, in that example, it's 2 passes. So because it's not sold at SSP, there is a prospective allocation that occurs first. Then they address the non-distinct. I think it was 1 obligation in that case, but it could have been multiple in terms of how they do the cumulative catch-up analysis sort of retrospectively for those specific obligations. So if you haven't seen it, that's one of the better ones I've seen. And if you're aware of any other good examples out there in the literature, we always want to see those. So shoot us a note or something. We'd be very, very interested.
Great. So we do have a couple of questions. If Tom and Kyle, you guys don't mind, looks like we have a couple of minutes left, so the timing might work out well. I mean, there's an interesting one right here. It's just pretty simply, for a company who has adopted the 606 guidance and is currently working through it manually, but is interested in automating, what would be the best first step? Would it be simply just defining a policy, or would it be having somebody come in, or would you recommend an outside consultant, or what, mechanically, what does that first kind of jumping off point look like from manual to automated?
I think it's a great question. I would say that's one of the reasons why we partnered so closely with CFGI, because there's always a question of adherence to the guidance and the actual policy, which is firmly in CFGI's wheelhouse, and then the question of and they do go hand in hand, actually. There's synergy here. So then the question of how do I operationalize that policy, and certainly there are trade-offs to be made. So knowledge of both sides of the issue at the same time, I think it's very valuable, in the end state. And so, we are working very closely with CFGI in exactly those situations. I think it's just a matter of probably initially some informal conversations, some discovery to understand a little bit more, and then next steps after that. I don't know, Kyle, if you have any other thought there.
Yeah, no, I would definitely echo what you're saying, and I think that's why this partnership works out so well. It's because you're going to need both sides of it. The other thing I would add is, as part of the informal conversations, is more so trying to understand use cases, right? So try to get your hand around how many potential modifications you could have, or different flavors of it. Are they adding new products? Are they taking away products? And understanding that, because then, like to your point, we can go with SOFTRAX and figure out what's the best solution here and how does that work for you.
Yeah. I don't know if we've made it clear, but CFGI is becoming quite expert on our technology in terms of operationalizing. They have access to sandbox instances, and I think in that scenario, that question that was asked, it's of a benefit, because they can be thinking about not only are the policies that are identified or will be identified proper, but do they fit in the context of the existing operationalization. And where certain things can be thought of multiple ways, there is probably an optimal way considering both of those facets. So that's probably the final thing I would add on that.
Great. Thank you both. Another kind of interesting question here. You had a slide on, the scalability, when scalability becomes an issue for combinations and modifications manually, but is there a certain point that seems to be a tipping point that you guys see? Is there a certain point that appears to be companies tend to say, well, this is finally too much work versus, okay, we can probably manage in Excel or manually?
Yeah. So I
You
would
take that one,
say
Kyle,
the
or-
tipping point. Yep. Sorry. So your tipping point typically going to be when you just the volume, right? You want to make sure that you're not kind of taking on too much volume. Like was mentioned before, is that some customers can do it because it's small dollars or small volume, but when you get too big and you have too many contracts, like some of my clients are doing thousands of these modifications, and it's just unreasonable to expect. Especially when you're slowing down the close, you start to have issues, you start to have manual processes. Is when you want to start to get to that point.
Yeah, I would say think of it in two different ways too, because I think that we often get the emergency request, like Kyle said, when it gets into, let's say, over 1,000 a month or something like that, then there's like, real pain in the organization just in terms of processing. But the earlier tipping point that should exist is probably when you get into the couple hundred or more a month. And I say that because we're seeing that error creeps in too much at that point and beyond. And so even though there's not extreme pain from a can we get the work done, there's sort of a hidden pain from the point of view of, is this stuff all correct? So I would say anything over a couple hundred. The other point I would make, and the reason why we wanted to get this webinar content out there, is we're just seeing more clients starting to adhere more strictly to the guidance. And obviously private companies have a little bit of leeway here, but it seems like it's ratcheting up. And so we're trying to get ahead of it because a lot of companies I think are going to start hitting these tipping points. So.
All right, great. Thank you both for sounding off. It looks like we're heading right up towards the end here. So I think what is going to be best is if anybody else has questions, you can feel free to submit them, and we'll make sure that your answers are, you receive your answers. We'll reach out after the fact. But thank you for watching. If you are interested in learning anything else about CFGI and its offerings, you can see Kyle's email right up there on the screen. I put my email up on the screen. If you have any questions about SOFTRAX, what we do, feel free to reach out. Kyle, Tom, do you have any final thoughts to leave our audience with?
Like Ian said, just feel.
Go ahead.
Sorry. Yeah, so like Ian said, just feel free to reach out with any questions. I've been through many of these implementations, some of them with SOFTRAX as well. So any questions, feel free to reach out.
Yep, and I would just say thank you all for attending. Again, any questions, reach out. We will forward a copy of the deck to everybody, and it's been a pleasure speaking with you today. So thank you.
Absolutely. As we end the webinar, you'll notice a short little poll for NASBA's purposes, just for the CPE purposes, will pop up on the screen. If you don't mind just clicking down just 5 multiple choice questions, that would be a huge help. And like I mentioned, we will distribute CPE directly via email. No more action required on your part. So on behalf of CFGI and SOFTRAX, thank you all very much for joining us today. We enjoyed presenting, and we hope to speak to you soon. Thank you very much.